The big advantage to investing through a corporation lies in the tax deferral of your income. As long as you can earn active income inside your corporation, you may be able to invest and compound up to double the amount each year over and over again. But let's dive into that a little bit deeper. Anyone can open a corporation. The key is that you are able to earn active income inside the corporation. Business owners, doctors, lawyers, and realtors are some of the common professions that allow for this. So instead of an employer paying you a personal salary, it is actually your corporation that is earning the income. Now, even when incorporated, you will always have personal expenses to cover. Things like groceries, vacation, mortgage on your principal residence, personal things like that. And to cover these personal costs, you will likely have to take the money out of your corporation in the form of a salary or a dividend. And once this happens, you pay personal taxes. So much of the tax deferral benefits of incorporation do not apply to this money. However, if you have excess earnings above and beyond what you need to cover your personal expenses, it may be beneficial to leave these earnings inside the corporation and invest through there. Let's go over why. For Canadian corporations in Ontario, the combined federal and provincial income tax rate is around 26%. However, when you factor in the small business deduction, and depending on how much you're earning each year, you may be able to get this down closer to 13%. So the tax range for active business income is 13 to 26%. On personal income, it's 20 to 53%. So your corporation will likely pay a lower tax rate on income than you will personally. With the ability to pay a lower tax rate up front, you can now invest more money. 5% on $10 is more than 5% on $5. It is that simple. Now, one day you will likely have to take the money out of this corporation, either to fund retirement needs or even potentially a death. Once this happens, it will likely come out as salary or dividend, so you are just deferring the tax bill. You're not eliminating it. However, tax deferral is powerful because it allows you to compound more money each year and then pay the taxes later. There are other factors to be aware of here. A corporation is taxed at the highest marginal tax bracket on passive investment income, which might actually end up being higher than your personal tax rate. As well, it sometimes makes sense to take money out of your corporation to fund your tax advantage accounts, such as your RRSP or your TFSA. You also want to invest efficiently to try and avoid compromising your small business deduction. However, with all that said, a good advisor in partnership with a good accountant will help you look at all these options before making a call.